All right, welcome to the first lecture. This is Nate. I'm your instructor. Now you know what my voice sounds like. And we're talking about accounting. Kind of a tough chapter to dive right into, but I figured we'd tackle the tough stuff first, and things will only get easier as we move along. So accounting is actually kind of fundamental that we start here because from a business standpoint, businesses run on numbers, and the bottom line is no profit, no business. So businesses have to make money in order to continue operating. And the way they do that is they have to manage their money, just like you manage your own budget. For those of you who live on your own, you know how challenging that can be. With a business, with payroll and utilities and rent and all kinds of expenses and varied income streams coming in, there's a lot to manage, and that's what accounting is about. One of the common problems that cause new business failure is not managing their cash flow. They have a successful business as far as customers coming in and sales, but they just don't manage the cash flow and they run out of money and they have to close their doors. So we're going to talk about the ways that companies manage that. We'll look specifically at the three main financial statements, which are commonplace across all businesses. And then we're going to look at the three financial ratios that mostly banks and investors use to kind of evaluate the health and viability of investing in a company based on those financial ratios. So here we go. Giddy up. Dive in. Talk about the three financial statements. First up, we see the balance sheet here. And these are also in your book. So regardless of what version of book you have, you'll note that I end this slide with saying read chapter 17, balance sheet. So make sure you read those definitions. It's really going to help you understand these even better. So the balance sheet is simply a snapshot of the company, and it's what they own versus what they owe. So it's your assets versus your liabilities and owner's equity, if you will. So this tells us if a company has enough assets to pay off their debt in the case of if they had to liquidate, if they went bankrupt. So furthermore on the balance sheet, we'll see, for example, here with Very Vegetarian balance sheet, December 31st, 2015, they have total assets underlined in red there of $826,000. Now that includes current assets of $600,000 up above and fixed assets of $206,000. On the right here, you'll see a definition of current versus fixed assets. Banks are interested in current assets because those can be liquidated into cash or cash equivalents within a year. Fixed assets are harder to get rid of in the event of a company going bankrupt. Below that, we see liabilities and owner's equity. Again, liabilities, what do you owe as a business? And you can see the categories there. We see that this company, Very Vegetarian, owes $613,000, split pretty evenly between current assets, things that are due within a year, and long-term assets that are due outside of a year. The third category is owner's equity, and that is basically retained profits, retained earnings. Like if you bought a house and fixed it up and you had sweat equity in the house from improving it, that's the retained earnings or the retained increased value of your company. So if a company makes profits and they don't give it all out as salary or stocks, it goes into retained earnings. So the balance to the balance sheet is assets, total assets always equal liabilities and owner's equity. So just remember that. And again, balance sheet, what do you owe versus what do you own? Income statement. So the income statement tells us, is the company making any money or not? And you see my screenshots here from the actual pages from the book. So again, I recommend you go and look at these in more detail. So we look at this. It's also called a profit and loss statement. Is the company making money? What are the revenues less what are their expenses? We see they have total revenues of $720,000 up at the very top of this sheet. And if you look all the way down at the very bottom, item 5 at the bottom where it says net income after taxes, $49,000. So they sold $720,000 worth of stuff, and they actually took home as income, net profit, $49,000. So that's pretty low. Sometimes it could be negative. Now you could own a business and still make money even if you didn't have any net income, like if you had taken a bunch of money out as salaries, etc. So this is the income statement. Gross profit is basically your sales. If you're selling shirts at 20 bucks a pop, and the cost of goods sold, the cost of those shirts, the actual cotton shirt and the silk screening is 10 bucks a shirt, then your gross profit would be $10 a shirt, right? So we see here they have $720,000 in revenue, and their gross profit is $290,000. And we can do some quick math and know that $290,000 is less than half of $720,000. So their profit margin as a percentage is somewhere below 50%. And this kind of tells us your gross profit. They're different for certain industries. But if your t-shirts that you're selling were super duper expensive, you sold them for $20 and they cost you $18, then your gross profit would be really low. And lenders would look at that as an indication of, you know, how expensive is the stuff that you're making? Can you source it cheaper? Net income obviously takes, subtracts everything else. Salaries, operating expenses, you know, rent, utilities, all that kind of stuff. And that really is kind of measure of how effective is the manager of the company or managers at managing their expenses, right? So, but bottom line, income statement, are you making any money or not? Revenue minus expenses. The last one is statement of cash flows. So the cash flow is telling us where is the money going? Not only the money that comes into the business, but the money that goes out of the business. Money that comes into the business is called cash receipts. Now that can be from operations, meaning you're actually selling stuff, or it could be from investment activities. We're taking our profits and investing them, like Harvard Law School. Harvard, you've heard of Harvard? They make a lot of their money from investments. They have this huge endowment where people give them money and they invest it, or they help fund new business startups and they invest in that, and then they get a return of the business. So Harvard's money, a lot of it comes from investment activities as opposed to operating activities. Operating activities would be money coming in from tuition, from students attending the actual college. And then another area where money can come in is financing. If you're a car dealer and you're selling cars, most people are going to finance that car. They can't just pay for it with cash. So you might be making money off of financing activities as well, lending your customers money, if you will. So that's money in, cash receipts. Money out, cash disbursements, same thing, just on the money going outside. Where are you spending your money? Are you spending it on operations? Are you spending it, are you funding a lot of money into investing activities? Which kind of tells us you have a lot of surplus cash if a lot of your money is going into investments, or money for financing, which could tell us, ooh, you have a lot of debt if you're covering a lot of loans. So you see here with Very Vegetarian on item 3 on that screenshot there, payment of dividends $15,000. So that is yeah, that's money spent there on them issuing money out to folks who own stock. So cash flow statement, where's the money going? Where's it flowing in and out of in the company? Okay, so that was the 3 financial statements, and these are going to tie into your homework assignment for this chapter. And then next up is the 3 financial ratios. So the ratios, what they do is they take all those metrics, all those financial numbers from the financial statements, and they just put them into some simple formulas to kind of determine these percentages. And then these percentages are used to compare them against other businesses in their industry. And they can quickly kind of tell, what's your earnings per share of stock? Ooh, your earnings are much lower per share of stock. You must not be doing well. So they're just kind of these ratios or formulas to kind of get a quick take on the health of the company. And these screenshots are also from your book. Now, if you have an older book, you're going to have to, thumb around a little book to find these in here, but I've copied them for you on this. So the three ratios are liquidity, leverage, and profitability. Liquidity is like it says. Banks would be very interested in running these liquidity ratios, like a current ratio and an acid test ratio, to find out, hey, if you go bankrupt and we're stuck with the remains of your business, can we liquidate you? Can we sell off all your stuff and get our money that we lent you back? So that's what liquidity ratios is. And you can see the formulas there with current ratio and the acid test ratio. The second ratio is leverage. So that is how much debt is the company carrying? So how leveraged are you? And they're concerned about that. Can you service your debt? And then the third one is profitability. And that's on the far right of your screenshots there. How effective is the company management, the CEO, etc., at maximizing profits? How profitable are they? So, and they pull all of these ratios directly from those financial statements that we were just talking about. So if you went to a stock quote site like a Morningstar.com or an E-Trade or any of those, and you're looking up a company's stock and find out what their stock price is, this is stuff we're going to learn out of chapter 19, you would see all these ratios listed in there. So check out those ratios. Okay, your next step after you've kind of read through these sections, and make sure you look at the reading assignments for chapter 17 and look at those terms in your book. And you can also look on investorpedia.com. If you don't find any of these in your book, that's another open source site where you can find some of this stuff. Your homework is going to be tied to the video with some questions following that video that you will answer on your discussion board. So look for the homework assignment under week 1 for that piece. Thanks for listening. This is some background about goodwill, which is what the video is about. I don't need to read all this off for you, but read this before you proceed to the instructions on how to complete this assignment. Okay, gang, so here's the specific instructions on how to do your homework. The homework is always going to be the discussion boards. So go back to the main menu on Blackboard, find the video menu link, click on that. You'll see discussion board 2 there with a video attached. The video is pretty large in memory size, so I'd recommend you right-click it as you open it. In other words, save as, save it to your desktop. It'll run better than if you try to open it directly while you're in Blackboard, which will really slow down your internet connection. And separately, make sure you have the discussion board 2 questions in front of you. So when you're ready for the video, you will first go to the discussion board section of the course, open that up, go to discussion board 2. You'll see the questions there that relate to this specific video. Print those off or have them in front of you on another screen, whatever you do. And then watch the video with those questions in front of you so you can take notes, obviously. And then when you have your answers all scribbled down or typed up, make sure you type them in a separate document, not directly in the discussion board on Blackboard. That closes a lot, especially if you're running a big video and all of a sudden your Blackboard freezes up and you lose all your work. You're going to be sad, and I can't help you with that. So just have a separate document, either Google Docs or MS Word, whatever you use, type it up in that, save it to your desktop, and then when it's all pretty, you want to copy and paste it into Blackboard in the comment box. Make sure you check for formatting. Sometimes it scrunches up spaces and all that, so make sure it looks good. Read the questions carefully. I do ask for sourcing on some of the answers, so you want to make sure you do that, or you will not get credit for that question. So read those instructions carefully, okay? Have fun with it. Looking forward to your answers. Thanks.